we have a company joining in. So Dipan, just stay on, and would like your view on this as well. Aether Industries is the stock that I'm talking about. It listed on 3rd June at 715 rupees. The stock is currently above the issue price and the listing price. But the margins, the earnings have been slightly on the weaker side in Q1. The revenue growth was tepid. It was just about 7%. The margins actually fell to 26.5% versus 30.7%. They've contracted. To discuss the earnings and the outlook, we're joined by Aman Desai, the founder and director at Aether Industries. Aether Industries is a specialty chemicals manufacturer, and they have 3 business models where they manufacture their own intermediates, and they also do contract research and manufacturing and some exclusive manufacturing as well. Thanks a lot for joining in. Aman, just wanted to start by asking you about your margin performance, which has been under pressure. Your EBITDA fell almost to 10%. What is the pressure that you're facing right now, and do you think it could extend into the next couple of quarters as well? Aman, I think you're on mute. Go ahead.
Unmute myself. So thanks, Sonia, first of all, for having us. Always a pleasure to be here with you guys. Yes, the EBITDA and the profits have fallen by a bit. I think it was 4% that the EBITDA has fallen from 29% to 26% quarter on quarter. And I think that's because of the global softening of the pharmaceutical industry. I think the entire supply chain, from the intermediates all the way to the formulations in the pharmaceutical industry, are suffering right now. Primarily, we think because of the COVID effect of people just didn't know what to expect and what was next in the COVID pandemic time. And therefore, people had built up inventory, and now we are seeing the effect of that. But overall, we are quite bullish, I suppose, to use a term in your jargon, but we're quite bullish about the year to come, and looking forward to many things to come.
Could you provide us with some guidance for the full year then? Is you bullish and you're seeing things to get better?
Yeah, Prashant, good morning. Basically, we expect Q1 and Q2 of the current fiscal year to be around the same, and be a little bit of a softening effect on it. But especially in Q3 and Q4, we have the new greenfield manufacturing site coming up, which is on track to be commissioned by the end of this calendar year, December. And so we'll see a reasonable, significant brunt of revenues from it coming in the last quarter of this fiscal year. And also, in terms of the CRAMS market, contract research and contract manufacturing market, we are seeing a tremendous influx of opportunities, as we had always foreseen in a post-pandemic era where the countries are opening up, the companies are opening up, and the external programs are being started. And so we see that effect also coming in the Q3 and Q4 of this year.
Aman, good morning. So apart from your organic plans, do you have any inorganic plans as well? Do you have any sort of targets in mind, any potential sort of kitty that you have for acquisitions?
Yeah, thanks, Anuj. Basically, no, right now. Currently, we have 2 new greenfield manufacturing sites coming up, our Site 3 and Site 4. And also, I don't know if you remember, but we also have a Site 5, which is a 31-acre plot of land bought in Panoli GIDC, which will be 12 times the size of our current production site. And so we are also kind of planning towards that. After Site 3 and Site 4, we have doubled our R&D, already operational. Tripling is going on right now and will be operational by this month. We have tripled the pilot plant capacity. We are adding a lot of customers, adding a lot of manpower. And so current focus is on organic growth and organic expansion. Very preliminary discussions happening on inorganic M&A type of activities, but at a very preliminary stage and at a very small scale. And so nothing as of now.
Okay, so what is the revenue expectation from Site 3 once it comes on board?
Well, we are typically have a ROCE, the return on capital of approximate 2 is what we have always done historically, and we are looking at almost 190 to 200 crores of capex on Site 3, and so I don't want to kind of put numbers out there, but hopefully significant numbers coming in.
Okay,
and that you'll see the full impact of that in the next fiscal year, but definitely a reasonable and significant impact in the last quarter of this current fiscal year.
Okay, that's good to hear. So you're sitting on a base of around 600 crores in FY22 is what I'm talking about. On an average, what kind of growth can you see in FY23 and 24?
Well, so you will have FY23. You will have the last quarter getting contributions from the current upcoming greenfield manufacturing site number 3, and you will see the full brunt of that of the 200 capex in the revenue contribution coming in the FY24. And so we are hoping for significant growth. Again, I'm very hesitant to put out numbers out there, but definitely very bullish on the future plans, especially in the manufacturing, and also as a result of the various tie-ups and strategic associations that we have established at the highest technical echelons of various innovators across the industry spectrum in the contract research and contract manufacturing space. And you'll see all of that coming into play as well by the last quarter of this fiscal year and the next fiscal year for sure.
So because I understand that you are a pioneer in continuous processing instead of batch processing, is that something that gives you an edge over other competitors, or how does it work?
Yeah, thanks, Sonia. A great question. I can talk about continuous technology and flow technology for, I think, 2 hours, and I don't think you want that. But absolutely, we are one of the pioneers, I believe, firmly in the country. If you go to companies who claim to have this competency and actually analyze the assets that they have and proven case studies at the R&D scale, pilot plant scale, and production scale, I think you come and see our capabilities, you'll find a vast differentiation in the footprint. And we have been one of the pioneers. This was one of our foremost competencies that we focused on when we started the company 9 years ago, and we continue to focus on that. And absolutely, yes, there's tremendous advantages that are obtained from translating a process from batch to continuous in terms of footprint, in terms of capex, in terms of opex, in terms of efficiencies, in terms of productivity, in terms of yields and conversions, which ultimately lead to cost competitiveness. And we see the benefits of this tremendously.
That was my question, actually. Does it lower your costs quite a bit? If yes, can you quantify it for us? And does it improve the quality as well?
It definitely lowers the cost. You should be a little cautious. Not everything can be done in continuous. Primarily, the chemical industry is batch-driven, specialty chemical industry, but there are 15 to 20% cases which should be translated to continuous, which we do. In terms of quantification, it's very difficult to provide. It's a case-by-case basis, but at an average, you can consider a cost competitiveness on the range of, say, 15 to 20% that can be obtained in a per kilo basis on a product, which is a good fit for continuous technology. In terms of quality also, the specifications are fixed for the customers, and so the quality has to be achieved, but the process to establish the quality might be easier in some cases from continuous processes as compared to batch processes.